are, we like the image of the bear. The bear. That's, I think that's from the Revenant, right? That's what the bear is doing to that guy. This is a takeoff of that Mad magazine. It shows you how old I am, in the late '60s, where that put National Lampoon, actually National Lampoon, not Mad magazine, National Lampoon on the map with this outrageous image. But we kind of took that image, and there's the bear paw IRS gun, putting the gun at the head of the bear. And of course, this is the bear. There's the guy in the shower with the bear. I'll leave that one alone there. You can infer what you want from that. But anyway, a little bit of humor. What happens, what we find in the world of tax, if you don't stay on top of your taxes, this is what you end up with. Relationships that somebody's mad at the other person. And this is what we try to avoid. We try to avoid this through planning, that's future tax management, current tax return management, proper filing, and if we didn't get the bills paid, then we deal with fast tax. So that's kind of where we are. Self-employed people, the reason I put that part in the self-employment tax thing is that historically what we see is self-employed taxpayers are the ones that have the biggest struggle with tax debt. And this is why. Self-employment tax is at 15.3%, and income tax is at 12 to 37%, depending upon how much you make. So there you're talking about a minimum like 27% right there. And then you've got, on top of that, you've got sales tax, property tax, excise tax. It ranges. If you're in a high tax state, it can be as high as 60%. If you're in a low tax state, best case is probably 30 to 35%. That's a big number. By far the biggest expense in your lifetime you will have, even more than a mortgage, a home. So that's why we focus on taxes, and that's why we focus on really helping self-employed, because this component here, the 15% plus the 12 to 37%, it's tough. So just a little quick overview of, on the income tax side, that's the 12 to 37%. That comes out in line 15 on Form 1040. The goal is to make that number as low as possible. That's line 15 on the Form 1040. That's taxable income. And then on line 31 of the Schedule C, you have the self-employment, the income that is reflected on self-employment tax. So the goal here is to make line 13 low and line 15 low. If line 31 is high, self-employment tax, that number is going to be a big number. And then, of course, if line 15 is high, that number is going to be a big number. So those two added together create your tax liability for that filing. So I went ahead and just put together some 10 tips here. These are tips that are related to specific tax deductions. They're more conceptual, and that's kind of where I wanted to start. So let's take the first tip on the revenue. Reporting of the revenue is what creates the tax liability. So that isn't really a tax deduction tip, but it's very important in that with these. Tip number one is your 1099 NAC and your 1099K. 1099 miscellaneous is for rental income. Those typically wouldn't be on self-employment, but you could throw that thing in there. You absolutely want to make sure that the total number in your revenues for that business, that Schedule C, at least is equal to or greater than the total of the 1099 NAC and the 1099K. If that number isn't equal to or greater, you will get a letter. Now, if it's $1 off, maybe not. But if it's $5,000 off, something's wrong. The IRS is expecting, let's say, 1099 NAC. They have a 1099 information return that was filed by somebody that paid you 1099. Let's say that was $15,000. Let's say you got a 1099K from PayPal or somebody, right? So that's $5,000. That's $20,000. If you don't have at least 20,000 in your revenue line on Schedule C, you'll get questioned on it. Hands down. You'll get a letter saying, "What's up?" Make sure that number is there. Make sure that if you get those 1099 NECs, 1099K, that you get those entered. Now, in addition to that, you are required to report number two, cash checks that are deposited. Those show in your bank account. They're going to appear, if you ever did get examined, they'll look at your deposits and say, "Oh yeah, we see the 1099s in here. What about these other things? We see those deposited. Let's say the 1099 NECs and Ks were 20,000. Let's say that's all you reported, but your deposits were 30,000, right? 20 for those 1099s, 10 for other checks or cash. You get audited. Why didn't you report that 10,000? So number two, make sure you get those in. Now I want to put in green, so I put the first one in red, as in red light. That should get your biggest attention. The second color is in yellow a bit. Doesn't look yellow from here, but it is. Good idea to put those in there too. Then let's talk about cash checks, cash or checks that are not deposited. I'm a realist. I know what happens out there. You get paid cash. You don't report that cash. You get a check. Maybe you run to the bank and get that deposit. That's not legal. I mean, you're supposed to report that, but it happens. But all I'm suggesting is that those are the three categories. You're supposed to report all of that. At a minimum, make sure you report an income numbers 1 and 2 at an absolute minimum. You're required to report the other one as well. But if you don't report the income on these two, you're just going to, especially this first one, you set yourself up for nothing. Enough on that. Let's talk about expenses, because this is how we keep that line, that profit line from going down. Here's number 3, expenses. Make sure you look at credit card statements, cash withdrawals, checks, Venmo, PayPal, a couple other ones that are out there I'm not thinking of. Make sure you look at all of those as expenses, potential expenses. Number 4, remember mixed uses. Cell phone, internet, automobile, travel, supplies. These are expenses that are typically mixed use. That's the term in accounting. It's part business, part personal. You want to do a reasonable allocation of those. Let's just talk about cell phone and internet. Let's just talk about cell phone. Keep it simple. If you're a single guy and you work nearly nonstop, that your work is your life. Let's say you're a real estate guy, or you're always on the phone, you're always doing deals, you're always talking to customers, you're always talking to whatever. Your cell phone is your life. You can take 90% of that, maybe 95%. If you're like me, I'm 100%. I'm always working, but 90%, something like that. But let's take another example where you're a family man. You've got 4 kids. They're all on the family plan. Your wife's on the plan. Your bill is $250 a month. You take all of that. That's not reasonable. I wouldn't advise you doing that. Do some reasonable allocation. Now, 50, 60, 70%, something like that, but certainly not 0%. I don't recommend 0% for any of these mixed use, because that's totally unreasonable, I think. And that just sets yourself up for criticism if you ever get examined. Internet's another one. Automobile, there's a couple different ways to deal with the automobile. Mileage method, I don't want to get into that. That's like another session all in itself that I might actually cover at some point. Travel, typically people like to, I encourage people to, when you do your travel, create a business purpose around it. Make sure travel can be a big expense. So make sure if you're a real estate guy, go out and look for properties. Try to find the next deal. Use it to gauge market trends. Talk to people. Supplies is another thing. They're mixed use there. So that's number four. Number five is more of information. How can you compile things? Five and six, I'm going to treat kind of together here. You typically do your transactions through a checking account at a bank or a credit card. Um, Certainly, you have the non-bank companies too, Venmo, et cetera. You want to be able to download the statements that come with those and keep those in your files. And you also want to download the CSV or XLS files. The CSV or the comment delimited files, or the XLS or the Excel files. You want to download those because then you can do some really cool things on analyzing and categorizing. Many of self-employed people don't get QuickBooks. That's the most popular one out there. They don't want to pay for an accounting system or can't justify it. Make sure you snag this data. I think you should do it throughout the year. You know, do it once a month, once a quarter. Grab those bank statements, grab those XLS files, and then you could do some really cool things with the XLS files. Put it into an Excel file or a pivot table and group and all sorts of fun things that really get accountants like me jazzed. But might bore you, but it really makes your life and your tax preparer's life much easier. Make sure you do that for your bank and your credit card statements. Any place that you receive money or you sent money home. Paid. Let's talk about some deductions. Be smart about your deductions. Some people will itemize their deductions. You have standard deductions, and then you'll have some itemized ones. There are times when there are itemized deductions that could or should go on your Schedule C, which is your self-employment return, or your Schedule E, which is your rental income return. Normally you'll want these on your Schedule C if it's business related. You can't just randomly decide you're going to take an itemized deduction and put it on your Schedule C or E. But if there's a business purpose for an itemized deduction, like interest, like property tax, like insurance, insurance is an itemized deduction, but any of those deductions that are on an itemized deduction, charitable contributions. When I made charitable contributions, yes, they were designed to support the charity. But let's face it, when many of us make charitable contributions, we're doing it to generate business. So many times I would put the itemized deduction for charitable contributions as a business development, because that was the reason I donated the 25 bottles of wine to the charity, so that people thought I was Mr. Successful and did business with me. And it worked. So be smart about that. You got to follow the rules on what goes on Schedule C or E, A, but keep that in mind. Number 8 here is retirement contribution. This is a mistake that I see people make. You know, they'll have a Schedule C and then they'll make their IRA contribution. Schedule IRA is after your Schedule C, so you want to, after your profit from your Schedule C is computed, so you'll end up paying self-employment tax on that, and then you make your IRA contribution with after self-employment tax. You don't want to do that. You want that contribution, that retirement contribution, to come out before the self-employment tax is calculated, and then you save that money. It's like a 15% deduction right there, savings right there. So make sure you do that. SEP, I think, is limited to like 20% or 25% of your profit, so you can put more in than the 5,000 IRA or whatever the limit is there. I think 7 for me because I'm 65 or whatever. So anyway, keep that in mind when you do your retirement contribution. Try to do it with on your Schedule C to save self-employment tax. Number 9 and number 10, I'm going to finish with this. This can be a little boring or nuanced tax stuff, but I call it ACL and PPE. This is when you're creating your business model. Again, I'm never suggesting that you just randomly select active versus passive. There has to be a logic and follow the rules on this. But just be aware that when you're incubating a business, let's say it's your latest and greatest idea. Um, that's you're incubating that, you're working it, you're managing it. All those expenses are deducted, are reflected in your Schedule C, which is will result in a reduction of your taxable income. And so when you're incubating a business or starting a business or you're taking a loss in a business, you want that loss to be in an active business on your Schedule C. That way you can reduce there won't be any self-employment tax on that. But remember, self-employment tax is paid on Schedule C. So you want to take your losses there, and that will reduce your taxable income on, say, some other W-2 without restriction. On the other hand, when you have another business that's kind of a passive business, and typical passive business would be rental income. You want those to be on your Schedule E, and you want those to be profits because those aren't subject to self-employment tax. So the ideal business model is one where you incubate it in the year 1 and 2, you prove up the model, but you craft your business purpose and business service offering around an active role. Let's just take a Airbnb type thing. Let's say you start with Airbnb. You want that to be an act. You're going to probably lose money in your Airbnb the first year or two. You haven't got your name out there. You put some money into the property to rent it out. Probably going to generate a loss in year or two, year 1 or 2. Make sure that you get that classified as an active business, and there are some rules you have to follow to demonstrate that you've got to do laundry, for instance. Maybe you have to offer coffee and tea and breakfast or something that makes it more like a true bed and breakfast, like I think that's where they got the name. And that's more of an active business. Then let's say after a year or two you do that and you realize, which probably would happen, you say, this is a nightmare. I don't want to have to do laundry. I don't want to have to do this. I don't have to serve people breakfast and scones or biscuits in the morning. I'm getting out of this business. But you got your name out there. Then it morphs into a passive rental thing where, oh, this is great. It's generating cash flow. Now you don't have to pay self-employment tax. So create your business model around the tax laws that give you a benefit to starting a business, losing money. They not reward you, but you get some tax benefit by taking a risk and trying to do something. And then if it doesn't work and you pivot a little bit, if you can pivot into the passive role, you'll take advantage of that loss in years 1 and 2, for instance, and then pivot it, move it into the passive role where you generate profits, but it's not subject to self-employment tax. So that's tip number 10. Not sure if that I think that covers everything I want. I want to remind you all to join Tax Resolution Help Center. $20, less than $20 a month. We want to keep offering really good content. It's our belief that the rich guys, top 1%, they get tax help 24/7, 12 months out of the year. It's the other people that, especially self-employed people, they need help 24 hours a day. So not just tax season, but all 4 seasons. So we hope that we can continue to do that. And to do that, we need your financial help and support. $20 a month to keep offering great content to you. With that said, I think I'm finished, and I'll turn it back over to you, May, and you can lead it from here.
Thank you. Thank you, Kelly. That was actually great. Now we have received a question This is one of our attendee. His name is Jake, and he's asking, "Can I file my business taxes with my personal tax return?"
Good question, Jake. The answer to that is it depends. Um, if it's a if it's a single member LLC, or if it's a sole proprietorship, or if you haven't structured a formal legal partnership, and you haven't filed it as an S corporation, but you're just running your business, you can file it with your tax return, your 1040 personal tax return. It goes on your Schedule C.
Okay, perfect. Thank you. And we have also another question from a private and sending it as anonymous. I have heard people say if I set up an LLC, it will help me with taxes. Is that true?
Well, an LLC, it helps you mainly with risk management, in that you can kind of put your business operations in that LLC, and your risk is contained within that LLC. Let's talk about that Airbnb idea that we went to. Um, you run your Airbnb, have an LLC. Um, you can you would certainly have your own property casualty insurance, umbrella insurance that might cover if somebody tripped or fell and sued you. Um, you could also have it as an LLC that would kind of further limit liability. That's what it stands for. LLC is Limited Liability Corporation. So it kind of limits your personal liability. So that would be helpful. Does it help you with taxes? Um, I would say that it LLCs also give you the presumption that you are in a legitimate, bona fide business. Not to suggest that anybody would create some fictitious business expense and write it off. And anyway, there's a lot of people that do things, but I'm not suggesting that would happen here. But it does give an element of credibility. And I personally believe that by setting up an LLC, by getting an EIN, a tax ID number, it gives a kind of an imprimatur of, okay, we're in this, we're going to do this to try to make money. This isn't just some scheme to try to take some operating loss to reduce my W-2 taxable income, that kind of thing. So I'm a big fan of it. It doesn't directly save you taxes, though.
Okay, thank you. All right, so we do have one last question we receive. The question is, can I deduct the money I pay myself and my wife on my tax return?
This is a question that actually is some of us kind of scratch our head. It's a good question because it it kind of it kind of eludes us about how that would work. But the answer to that is no, unless you're a certain type of company. If you're a single member LLC, and you're a sole proprietor, if you think about the logic of, let's say you paid yourself $10,000 in income, yeah, you could deduct that as $10,000, but you'd also then have to report it as $10,000. So yeah, you could deduct it as $10,000 off your LLC income, and maybe if you wanted to do that for some kind of accounting, internal accounting reasons, you could do that. But as a practical matter, you don't do that. You simply don't pay yourself 10,000. Or you can take it out of cash, but you don't take that as an expense deduction, and that would increase your profit by $10,000, and that profit shows up in your Schedule C profit when you file your tax return. So the answer to that normally is going to be no. If you just Schedule C, you don't need to pay yourself, and then therefore you don't need to declare it as income if you did pay yourself. I hope that was clear. Maybe it wasn't, but you need help, feel free to reach out to a tax expert.
Awesome. Okay, that's it for our question. No more questions coming.
Okay, all right.
Thank you, Kelly. Now, well, that covers that covers it for this session. I want to thank you for attending our commitment. Our commitment is to help you reduce your taxes and increase your wealth. We do this with a try tax method of DIY, do it yourself, DIT, do it together, and DIA, do it all. Three methods, one solution. Reduce stress from no IRS or state tax debt and a happier, healthier life. If you are not yet a member, please join for less than $20 per month. We need your support to continue to offer more of these sessions. We have many sessions to help you deal with taxes. Since it is now tax season, we have many sessions to help you do a better job of doing your taxes yourself. And of course, if you want help, we have a team of experts who can do the tax return for you. I want to make sure you know we have many more sessions being offered every day and every week throughout tax season. Many will help you with this year's taxes, and others will help you with your past tax debt. So check out our website, that's learn.taxresolutionhelpcenter.com. Thank you for attending. All right, I will be ending now the session. Thank you, everyone. And thank you, Kelly.
Thank you.
All right, ending the session now.